Forex. Catchin. Hey, it's your man Charlie P. And we are about to learn Forex, or foreign exchange currency trading. This video is going to be the basics of the basics. So if you already got a little groundwork, a little foundational knowledge or whatnot, you can skip this. This ain't, I'm going over stuff like what is a pip, what is Forex, that type of stuff. So nothing strategic on this one. I'm gonna do this in the most simple way I can. There's a lot of information that I know that I'm not gonna teach, not because I'm trying to withhold the secret sauce and make you pay me for the real strategies and all that kind of stuff. It's just because I don't use it, so I don't want to confuse you for no reason. Anyway, yeah, I've been trading for about 6 years and made a whole bunch of mistakes along the way. And my goal is to minimize the amount of mistakes and the amount of time that it takes you to become a consistent trader. If you got questions along the way, put them in the comment section. I'll address it in a follow-up video, or if it's simple enough to just respond under your question in the comment section, then I'll do that. But anyway, yeah, let's do this.
All right, let's jump into it. So what is Forex? Forex is short for foreign exchange. You got the for, that's foreign, and then the X is exchange, so Forex. It's also referred to as the FX or currency market. And then lastly, foreign exchange tells us the value of currency A when it's exchanged for currency B. Now, what do I mean by that? So let's do a real world example. I live in the United States. Let's say I'm traveling to Canada. I want to use Canadian money when I get there. I need to know how much does $1 get me in Canadian dollars. So I can actually just come to Google and look it up. So if I type in $1 to, here we go right here, $1 to Canadian, it's telling me that $1 is going to get me 1.26 or $1.26 in Canadian money. Now let's go to a Forex chart, and don't worry about if this looks confusing. I just want you to see that this is actually, if you look at the top, the USD Canadian chart, and it tells us here where price currently is at this very moment, 1.26469, which is going to round up to $1.26, exactly what we just saw on Google. But anyway, this is literally the foreign exchange market. I just wanted to point that out. Also, something cool to know, every single day about $5 trillion is traded in Forex versus only, it sounds silly saying only, but I mean, it's a lot more than the stock exchanges. So 22.4 billion, 18.9, 7.2 billion on the stock exchanges. And it's weird that we grow up, we know about stocks and investing in stocks, but we don't know anything about Forex, even though it's a way bigger market. But because it's a much larger market, and because a lot more money is traded on a daily basis, that means that technically you can make a lot more money a lot faster. But on the flip side, you can also lose it a lot faster. So you have to be a lot more careful. A lot of people are scared of the Forex market because it's very volatile. It moves pretty quick. So you got to know what you're doing. Okay, so next we'll talk about Forex pairs. All right, so the currency pairs that you see over here on the left, this is how you'll see it in the markets. The market's going to say EUR/USD. That means the euro versus US dollar. And then the nickname for that is EU. The nickname is what you'll hear me refer to these as. And also when you're talking to other traders, they're mainly going to use the nicknames or the initials. So if I say I'm in a buy on GJ, they know I'm talking about I just got into a buy on the British pound versus the Japanese yen, or G-Chif, British pound versus Swiss franc. Now you can pause this and just look through the rest of them to see what each currency pair represents. And we'll go ahead and go on to the next slide, which is what you really want to know, which is how do we actually make money trading Forex? So in order to make money trading Forex, you need to understand these 3 bullets. Pips, you need to know what is a lot size, and then understand pip value. I just tacked on a screenshot from a trade I was in a couple weeks ago one morning. This is right before I took profit, just showing like you can make some decent money trading. And I know all this probably looks confusing right now, but I'm going to break down everything to where we can actually come back to this screenshot and you'll understand it. But let's keep on going. Let's talk about pips. In this particular example, this would be on the GBP USD chart, which is telling me how many US dollars would I get for my 1 British pound. In this situation, we're looking at $1.35, but the way pips are calculated, it's a few more decimal points on down. Whenever you see the dollar amount, just keep this in mind. Don't worry about the last number. Just get the last number out of your brain. So this 1, we just want to pretend like it's not there. This is the point where pips start. The way that I do it is I take this number, the second to last number, and I usually just go ahead and include these last 2. So 536, and then over here I would say 537. That's 1 number different, so that's 1 pip. So the way we actually make money is by getting into a trade. And when I get into a trade, I have to say, I'm going to risk a certain amount of money for every pip the market moves. Let's say let's keep it simple. For every pip the market moves, I'm going to risk $1, $1. So if the market goes 50 pips in my favor, I just made $50. If the market goes 10 pips against me, I just lost $10, so on and so forth. Now, this is why I'm calling my channel Catching Pips with Charlie P, not, make all this money with Charlie P, blah, blah, blah. Catching pips is the most important thing by far. If you can catch the pips, the money's going to come. I'll see people post screenshots and, they'll be like, oh, I made $400 or something like that. But then I look at the risk amount and I'm like, you put $100 per pip on there. All you caught was 4 pips. Like, that's not impressive to me. And the reason that's not impressive is because, once you learn how fast the market, how many pips the market can move in a matter of seconds, and then that means you could have lost that same $400 in a few seconds. To me, that's kind of like, honestly, I just look at it kind of like that's luck. That's just how I see it. That's not necessarily the case. There are some people that do what's called scalping. You can look at, I'm not going to go into all that. And they're really good at it. And shout out to them. I'm not built for that life. I want to know where the market's going and be confident that it's going to go in that direction for a while. So I can take the trade and walk away from it, not take the trade and be sitting there like, oh, I gotta be ready to get out because I'm not sure if it's really going up or down. And I just try to take what I can get. Man, I ain't got time for all that. But anyway, just get consistent catching 50, 60, 70 pips. Once you get consistent catching a large amount of pips, the money will come. You can just gradually increase your risk every, subsequent trade that you take, and the money will come. Your account will build up. Now let's talk about that risk. That is lot size. The lot size is how you determine how much you're going to risk per pip. You've got micro lots, mini lots, and standard lots. So your micro lot, and the way you want to look at all of these is just multiply it by 10. You multiply them by 10, and that'll tell you how much money per pip you're risking. If you want to risk 10 cents per pip, put in what looks like a penny, and that's actually 10 cents per pip. Or if I wanted to do 50 cents per pip, I would put 0.05, and that would be 50 cents per pip. So on, so forth. If I'm going to put $20 per pip, that would be 2.00, or it looked like $2, but again, I multiply it by 10 in my head, and I know that's going to be $20 per pip. And then I've got more examples down at the bottom just to show that you're not bound to just, ones. You can use whatever variation of numbers you want to use. Just keep in mind that whatever you're putting in the risk amount, is going to be multiplied by 10, and that's what you're actually risking. Okay, the third thing you need to understand is pip value. This is the least important thing, but you do still need to understand it because it can be confusing. Basically, what this means is the Euro USD, for example, you get 100% of whatever you're risking. So let's say $10. If I'm risking $10 per pip, then when I put the trade in and the market starts moving pips, I'm literally making or losing $10 per pip, 100% of the value of my risk. However, something like GJ is 91% of the pip value. So now I'm making or losing just 91% of my risk. So that same $10 would actually be $9.10. So let's say the market goes 10 pips in my favor. Well, 10 pips at $9.10 would be $91 that I would make in profit, versus if I had that same 10 pips in Euro USD, then that would be $100. So that was confusing to me in the beginning, because I remember getting in a trade on a pair that wasn't 100% pip value. And I'm like, why is it only going, I think actually it was probably USD CAD. It was probably UC. And I'm like, why is this mug only giving me, $5 when I feel like it should be like 8 or something at this point? And that's when I had to realize, like, oh, every pair isn't 100%. So I'm just throwing that out there. Like I said, it's not that important. One thing I do want to say, though, is pairs that are not 100% pip value tend to move more pips than the ones that are 100%. So I don't want you to think that, well, why would I mess with those if they're not even going to pay out as much money per pip? Well, because they usually move more pips. So it kind of balances out. All right. So next thing, trading sessions. Trading sessions are basically where certain parts of the world have a majority of control over the market at a certain time of day. The main things you need to take away from trading sessions are this. Number one, the trading day starts at 5 p.m. Eastern. All these times are Eastern, so just convert it to whatever time zone you are. Like I'm Central Time, so that would be 4 p.m. for me, that the trading day starts each day. But here's the main takeaways. Don't look for any trades during the Sydney, when Sydney market opens. Nothing's going to pop off that's significant. When Tokyo opens at 7 p.m., that's referred to as the Asian session. So if I say, oh, are you trading Asian session? That means, are you trading around 7 p.m. Eastern time? I normally don't trade around this time, but there are certain times where Australian pairs and yen pairs tend to pop off and, make their moves for the day starting around 7 p.m. Eastern. I would say it's safe to look for trades between 7 p.m. and 8 p.m. Eastern. Then London session, that starts at 3 a.m. Eastern. So there's times that I'll analyze the market before I go to bed to see if I need to bother waking up in the middle of the night for, to catch a move during London, because London, big moves happen a lot, especially with the GBP pairs. It happens all the time during London session. So I would say 3 a.m. to 4 a.m. Good times to look for trades. Also, New York session starting at 8 a.m. That's the best time overall to look for trades. I think most pairs as a whole do the most movement during the New York session. So 8 a.m., I would say those first 3 hours, 8 a.m. to 11 a.m. Eastern, are the best times to look for trades. Any times outside of those, I really don't, I'm not going to enter a trade. 99% of the time, I'm not doing it. So again, just to repeat that, 7 p.m. through, we'll say sometime between 7 p.m. and 9 p.m. Eastern, somewhat safe to take a trade. 3 a.m. to 5 a.m., safe to take a trade. 8 a.m. to 11 a.m. Eastern, safe to take a trade. Outside of that, don't get in the trade. If you're in the trade already, you can let it ride. But I'm saying, as far as entering the trade, outside of those times, don't bother. Okay, so let's talk about forexfactory.com. This is something, a website you're really going to need to know about. I've got it saved in my favorites here because I go to it every morning. Forex Factory is going to tell you what financial news events are about to happen for that day. What you want to focus on is red folder news. So you've got your times, your folder colors. You've got the yellow folders, red folders, orange, and then if it's a holiday or something like that, then the folders will be grayed out. But mainly what you want to focus on is just the red folders. That's really all that I care about when I come to Forex Factory. So today, for example, and then let's also, I'm glad this is showing this. It says 2:20 p.m. right now, which that's Eastern time. I'm just going to click on that and hit save settings, and then it'll automatically change it to my synchronize it with my time zone, and then I'll just refresh this. That's how you fix that when you go to Forex Factory, just so you know. And I actually forgot that I had set that up to happen so that I could show that to you. But normally, yes, when I click on Forex Factory, it's already on my time zone like it's supposed to be. But when you first go to it, if it's not, that's how you fix it. All right. So again, all you're focusing on is red folder news. So for example, let's say this morning when I woke up, I saw that there was about to be some major news for the Canadian dollar. What this means is a lot of times if it's red folder news, the market will go berserk. It's going to go crazy. Not all the time, but a lot of times. This can cause a very big price spike. And so it's a good idea to stay out of the market if you're not already in the trade on that particular, with a pair that has CAD in it. It's a good idea to just wait a little bit. Wait till like 8 o'clock or 8:30 before you try to enter it, because it can be a big price spike. Let's actually find an example if we can. Actually, well, shoot, here's one right here. So this was September 14th. Let's actually look at yesterday's news. Okay, so there was USD news, red folder news at 7:30 in the morning yesterday. Back at the chart, that's actually basically this blue box. This is yesterday around 7:30. The market dipped down pretty quick, and then it decided to go up for the rest of the day. So it fooled a lot of people, making them think, oh, I'm about to sell it. But this was the news throwing the market for a loop, when they knew the whole time they really wanted price to just go up for the rest of the day. And so, people might have jumped in a sale or saw it going down, like, oh man, I got to get in a sale. And then they hop in a sale like down here or something. And then the market goes yule on them, and, they done got jacked up. But anyway, news can just make price do some, it can make price move pretty crazy sometimes. That's really all you need to know. The only other thing that I would like to mention, let's see, I know we just had a holiday. Oh, here we go. So this was Labor Day. And so for the US and Canada, we have gray folders. What this means, and I don't know why it works this way, but just keep in mind, anytime that you have a US bank holiday, don't even bother trading that day. The market's not going to move a lot at all. There's no point in getting in the market. Just rest your brain. You can study your strategies or whatnot, but do not enter the market anytime you have a bank holiday. So September 6th, that Monday on Labor Day, I guarantee you I wasn't trading. Okay, let's go to the chart, and let me actually log into my demo account so that I'm not taking a trade on a real account. Okay, so I'm in my demo account now, and I'm going to take a trade just to, which I would never take a trade at this time of day. That's why I wanted to do this on demo, but I'm going to take a trade. And right now you see this 37 and 38. That is a spread. What the spread is that tells me, which my spread is currently 1 pip. Remember, this last number, we don't too much care about it. It does make a difference, but just to keep it simple, we got 37 and 38. That's 1 pip. So if I'm going in this with $1 per pip, then I'm sorry, I done jacked up. I'm going in this with $10 per pip. Then that means I'm approximately $10 in the negative as soon as I take this trade. I'm gonna show you what I mean. I'm about to just put a sell in. Boom, I sell it. I immediately go into the negative about $6. The reason why is because, remember, this is a 71% pip value. So instead of being $10 per pip, is about $7 and some change or whatnot. And so that threw me into the negative immediately. That's a spread. That's how the broker makes their money. Anytime you get into the trade, you're gonna have to make a spread, pay the spread until I get enough pips. So basically, until I go more than 1 pip in profit, then my dollar amount down here is gonna stay in the negative. Now, as you can see, I've already got a little bit more than 1 pip in profit. So that's why I'm no longer in the negative. I have made that spread back. The other thing is commission. You've got spread that you're going to have to pay the broker, and you have commission you have to pay the broker. The commission is really cheap on turnkey Forex. That's why I like them. For every standard lot, which this is a standard lot, so for every $10 per pip that you risk, I'm sorry, anytime that you place a trade that is $10 per pip, you pay a one-time $2. You're not paying $2 per pip or nothing like that. It's just a one-time $2 commission to take the trade. And so in general, I have to make my commission and my spread back before I go into profit. That's really all you need to know on that. So on the flip side, let's do another trade at a different amount. Let's say I'm going to do 10 cents per pip. Let's make a sale on that. So on that one, I went into the negative just 2 cents right away. And then my commission was only 2 cents on that. So I did that just to show your commission and your spread amount will always be relative to your lot size. So the bigger your lot size, the bigger your commission and your spread amount will be. We can see the market is kind of in a downtrend here. So I've gone into profit. So let's just say I want to get out and take my money. Boom. That's how you take your money out. You just exit out of the trade anytime you want to, because I know a lot of people say, well, you know, do I have to stay in the trade for a certain amount of time or whatever the case? No, you can get out whenever you want to. And again, this is a demo account. My next video will be showing you exactly how to set up a demo account. And I will also break down every single thing that you see on this chart so that it makes sense to you. And I guess the last thing I'll do right quick, just to show, I'm going to go into a live account, which, I mean, I've got multiple accounts for different levels of risk, but let's just go into one of my live accounts. And this account, I'm actually in a trade on. So now you see this doesn't say demo up here anymore. It now says live. So this is an account with real money. Now I am going to block out my dollar amount, my risk and everything on this just because, but I'm going to show you a trick on just how to tell how many pips you've gone in profit. So as you can see, I jumped in the trade up here. Again, we'll go into what these lines are, the white and the red, on the next video. But just know in general, these are two spots, the white lines specifically. These are two spots where I got into a trade this morning. I can take this little tool here. This is where price is right now. And I drag this up to one of my my white lines, and that 500 you see in the middle right there, that means 50 pips. Or if I drag it up to this one and now it says 53.1, essentially that's 53 pips. So I'm 50 pips in profit on this trade. I'm 53 pips in profit on that trade. So I'm not, you know, saying something I don't do. I catch pips out here. Like this is what I want you to do, is be able to catch a large amount of pips on a consistent basis. And we're going to get you there. Just keep watching, keep learning. And yeah. Okay, now that we know what pips, lot size, and pip value are, let's take a look back at this slide right here. And let's bring up a calculator. So just remember, this is a trade I got in on GCHIF, which the pip value on GCHIF is 109%. So it's actually more than 100%, which, yeah. But so let's pull up the calculator and let's make this make a little more sense. Let's look at our pips. So remember, we act like the last number isn't even there. I'm going to just say 611 and 658. So 611 to 658. Let me do that backwards. 658 minus 611. That's 47 pips. All right. So 47 pips times my lot size, which is 2. That's $20. I just exited out of my calculator, didn't I? Dummy. But that 47 pips times $20, that's $940. Well, that doesn't equal, you know, what this says. Well, that's because, remember, it's 109%. So I need to take my 940. I can multiply that by 109%, which would be times 1.09. Now that gives me 1024. The reason 1024 is, well, I mean, it shows approximately what what that is down here. The difference between this number saying 1021 and this number saying 1013 is my spread. Remember the spread that we had to pay in the beginning? That is just the difference here. So my spread on this particular trade was approximately what, like $8 or something like that. So just making that make a little bit more sense so that you understand how pips, lot size, and pip value equate to how you make money trading Forex. And okay, I'm going to shut up for real this time. I just forgot to add that in. And this is a little bit bootleg for me to just tack this on to the end right now, but that's just what it is. We keeping it real around here. All right, y'all.